Welcome to Money Daily. Tuesday, January 6th, 2026. The S&P 500 rose 42.77 points, up 0.62%, breaking above its previous high and setting a new all-time record at 6,948. This is the first time the index has hit a new high this year, and realistically, this won't be the last. Today is just the first of likely many new highs in 2026. Yesterday, a viewer commented, "Everyone else is bearish, you're the only one who's bullish. I followed you, and it was the right call." The truth is, in the US stock market, betting on the upside has a much higher probability than betting on declines. The hard part isn't the logic, it's the execution. Indexes can go to the moon, but your personal portfolio doesn't always beat the index. Based on my own analysis, the number of up days exceeds down days by about 11%. Don't miss today's episode. Okay, let's go. Shorting or staying bearish on US equities is essentially betting against probability. It requires both timing and luck, because you're wagering on the less likely outcome. The Nasdaq is slightly weaker in comparison. There's still overhead pressure, mainly from a downside gap formed earlier. If this week or next week the index can gradually reclaim the gap from January 4th, the Nasdaq will likely move to new highs as well. With the S&P already at record levels, the odds favor the Nasdaq following along. These two indexes share many of the same heavyweight stocks. About 79% of Nasdaq 100 components are also in the S&P 500. In the end, their overall direction tends to be the same. Meanwhile, the Russell 2000 appears to be emerging from an upward wave, suggesting small-cap stocks may be starting to catch up. The Russell 2000 includes the companies ranked 1,001 to 3,000 by market cap within the Russell 3000, about 2,000 small and mid-sized firms. Each stock carries a very small weight, and gains and losses often offset each other. That's why the Russell 2000 rarely shows the same strong trends or magnitude of gains as the S&P or Nasdaq. However, after a long period of wide-range consolidation, the Russell 2000 now seems to be forming an uptrend. This raises an important question. Is the market shifting from extreme concentration into a broader participation phase, where more individual stocks start to rise? Looking at the S&P 500, since mid-last year, the number of advancing stocks has indeed increased. About 61.63% of S&P 500 stocks are trading above their 50-day moving average, and 60.03% are above their 200-day moving average. Statistically, if you randomly pick 3 S&P 500 stocks, the odds suggest 2 of them are in a profitable trend. That said, market breadth is still below 70%, which means we are not yet in a true broad-based bull market. Index gains are still driven mainly by heavyweight stocks. Participation from mid and small cap stocks has improved slightly, but it's not enough to call this a full everything rally. Even though the S&P and Nasdaq are at record highs, many stocks, especially smaller ones, have yet to move meaningfully. From here, the market has 2 possible paths. One scenario is that small and mid-cap stocks continue to play catch-up. The upward movement in the Russell 2000 would be a clear sign of that. This would be a healthier and more investor-friendly outcome. Stocks that haven't risen yet move higher, while the already extended names advance more slowly, forming a broad-based rally. The second scenario is less pleasant. Large-cap stocks fail to hold up, drag the indexes lower, and trigger a correction. In that case, the small-cap stocks that haven't gone up much would likely fall even harder than the overall market. That's the more painful path, and it tends to test everyone's patience. Monetary policy is the weather vane for the stock market. So the big question this year is, how much easing will the Federal Reserve actually deliver? Today, 3 Fed officials made public comments. The most dovish voice came from Elon, who openly argued for a sharp rate cut, up to 100 basis points. In his view, current monetary policy remains restrictive and is holding back economic growth. That said, Elon is only a temporary Fed governor. His opinion doesn't really carry much weight, and his term is ending soon anyway, as he's expected to return to work with Trump. Minneapolis Fed President Neel Kashkari said today that current interest rates are close to the neutral level for the US economy, and that monetary policy is not putting significant downward pressure on growth. He emphasized that future policy decisions will depend on upcoming macroeconomic data. Meanwhile, Fed official Barkin pointed out a contradiction: rising unemployment alongside inflation that refuses to come down. There is clear disagreement within the Fed over how much rate cutting should happen this year. Both officials are essentially waiting for more data to guide policy. This suggests that, aside from Elon, who is on his way out, most Fed officials are still unsure about the direction of interest rates this year. In reality, beyond the data, they're also waiting for one person, the next Fed chair, who is expected to be nominated by Trump later this month, and then go through congressional approval. My expectation is that monetary policy in the first half of the year will remain relatively hawkish. Once the new Fed chair takes office, policy may turn more dovish. If that assumption is correct, US equities could face a more accommodative monetary environment in the second half of the year, making the outlook for the latter half more optimistic than the first. Turning to individual stocks, Tesla rebounded for one day after 7 straight down sessions, but then resumed a sharp decline today. At the Consumer Electronics Show in Las Vegas, Nvidia CEO Jensen Huang delivered a keynote speech. Nvidia continues to move at an extremely fast pace technologically, unveiling its next-generation AI computing platform, Rubin, which is scheduled for delivery in the second half of this year. Rubin's inference performance is said to be 5 times that of Blackwell, while the cost per AI token drops by 90%. As long as Nvidia maintains its technological lead in AI chips, its dominant position in the market can continue. Jensen Huang believes AI has now entered the era of physical AI. Nvidia also announced that its autonomous driving vehicles will begin road testing in the US in the first quarter of 2026. The company introduced an open-source reasoning model called AlphaMayo that helps vehicles understand road conditions and make decisions. Why to change lanes, when to brake, more like a human driver. By open-sourcing this model, Nvidia is essentially creating the Android system for autonomous driving. In the smartphone world, Apple has iOS, while non-Apple phones use Android. In the future electric vehicle industry, Tesla may represent one system, while other automakers could adopt Nvidia's platform. Tesla's full self-driving has long been the industry benchmark, and a large portion of Tesla's valuation comes from its autonomous driving capabilities. Now that Nvidia has entered this space, how big of a blow is this to Tesla? Is it a major negative? Previously, Tesla stood alone. Other automakers potentially had to pay Tesla to use its autonomous driving system, with Tesla's approach becoming the industry standard. With Nvidia offering an open-source alternative, that dynamic changes. Non-Tesla brands no longer need to pay Tesla for an autonomous driving platform. Naturally, these competitors are more likely to choose Nvidia's ecosystem instead of cooperating with Tesla. In simple terms, automakers that once had no chance of challenging Tesla's self-driving technology can now integrate Nvidia's open model and instantly raise their competitive position. That is clearly unfavorable for Tesla. Nvidia also announced plans to enter the robotaxi space, which adds yet another layer of pressure. In the world of Tesla's FSD, robotaxis, and the 3 core components of autonomy, Nvidia has now become a powerful rival in 2 of them. Elon Musk responded on X, saying that Nvidia is essentially doing what Tesla is already doing, but they will find that achieving 99% accuracy is easy, while solving the long-tail edge cases is extremely difficult. How should we understand this? I think generative AI and autonomous driving face a similar challenge. Today's generative AI tools all look usable and impressive, but some make frequent mistakes, while others confidently hallucinate nonsense. Getting to 99% accuracy is relatively easy. Reaching 100% is incredibly hard. Autonomous driving is the same. A car can drive itself most of the time, but errors are simply not acceptable. When human lives are at stake, solving that final 1% is extraordinarily difficult. Despite the arrival of strong competitors, Tesla still retains certain advantages. The company has accumulated around 7 billion miles of real-world autonomous driving data, which is extremely valuable for training. Competitors simply don't have datasets of that scale. So in the short term, the impact may be limited. But over the long term, the landscape could change. This undeniably introduces new challenges for Tesla's valuation. In the semiconductor sector, it's not easy to find a stock that still looks reasonably valued. Last year's top 3 gainers among memory stocks have continued to surge at the start of this year. SNDK jumped 27% today, Western Digital rose 16%, and both appear to be entering a rapid, accelerating uptrend. Micron also posted a strong gain, close to 10%. The stocks that performed best last year are showing signs of further acceleration this year, especially with earnings season approaching. Capital is moving in early, betting on strong earnings growth. When earnings expectations are high and results come in strong, prices often react sharply upward. The problem is psychological. You've been watching these stocks for a long time without pulling the trigger, and the higher they go, the more anxious it feels. If you chase them now, the probability of continued upside is actually fairly high because you're following the trend, but your cost basis will be higher than everyone else's. That makes your mindset unstable, and when a pullback comes, you're more likely to sell too early and fail to hold the position. At this year's CES, Qualcomm unveiled its robotics chips, but the stock did not surge dramatically. With semiconductor stocks broadly rallying, the question is whether Qualcomm could play catch-up. What do AI data centers need? That's where the business opportunities are. This same logic previously drove GPUs, and now it's driving memory stocks. Data centers have two major pain points: massive power consumption and extreme heat. Qualcomm's AI 200 and AI 250 chips are set for large-scale delivery this year. Meanwhile, Micron's HBM memory is in short supply and very expensive. Qualcomm's chips use LPDDR memory, which is significantly cheaper. Qualcomm's accelerators focus on inference, while Nvidia dominates training. This differentiation gives Qualcomm an edge in improving data center efficiency, reducing power usage, and lowering overall costs. At the same time, Qualcomm is also a leader in edge computing. Data processing happens across three layers. First is the endpoint, devices like computers, smartphones, cars, and future robots, all equipped with their own chips to process data locally. The second is the cloud, where large-scale computing power resides in data centers. Data is sent from the endpoint to the cloud, processed, and then sent back. But for certain scenarios, sending data back and forth creates serious problems. In autonomous driving, for example, if a pedestrian suddenly appears on the road, even a 100-millisecond delay while waiting for cloud instructions could cost a life. Edge computing sits between the endpoint and the cloud, providing much faster processing close to the device. At CES, Qualcomm announced that its Dragonwing 100 chip, designed specifically for robotics, will serve as the brain of future robots. Looking ahead, humanoid robots could see enormous market demand, and there will come a time when robot chips scale rapidly. In Qualcomm's most recent earnings report, revenue showed positive growth, but profits declined sharply. Aside from the third quarter, profits in previous quarters were consistently positive, typically above 20%. The profit decline in Q3 was mainly due to a sharp increase in income tax expenses, rising to $6 billion, caused by a one-time deferred tax charge stemming from changes in tax law. This is not expected to happen again. As a result, Qualcomm's profits should return to positive growth in the fourth quarter. Recently, the stock has shown potential for an upside breakout, with a chance to challenge the 200 level. Personally, this is a stock I'll continue to watch closely. Alright, that's all for today's episode. If you want to learn more about these topics, please like the video. Subscribe to Money Daily for more timely and accurate insight.